Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
Good morning. Happy Monday to everyone out there. Monday, 31st of March. It's the last day of March already. Unbelievable. Welcome, everybody. Happy Monday. Welcome to another edition of Wealth Coffee Chats. For those that haven't met me, I'm a long-time listener, first-time caller. I'm Jared Redman. I'm a property investment coach here at Positive Real Estate. And I'm excited to be bringing today's edition of Wealth Coffee Chats to you guys, where we're going to debunk some myths, the top 10 myths around property investing in Australia. And I've got my comrade, Fadi Najjar, here from the Melbourne office, another wonderful property investment coach. How are you, Fards?
I am doing good, Jared. This is, like you said, first time going at it now, so looking forward to it. 31st of March, already crazy. We're already closing the first quarter of the year, and it's gone by so quick, but looking forward to sharing and busting some myths today and, sharing some really good insights with our listeners today.
Excellent, buddy. Well, yeah, we were just chatting a few weeks back about just some of these misconceptions or the myths around investing, weren't we? And we said, well, why don't we do a live on it, 4 or 5 of our top ones each and a bit of tandem, and we'll go back and forth and just explode some of these myths and talk about our experiences around them. And as we know, these are short, sharp podcasts, so we'll keep it pretty high level, but we'll get stuck into it. Welcome to everyone joining. G'day, Bunty. How are you? Good morning, Courtney. We've got a few joining in. G'day, Chris. How are you, mate? How are you doing? We've got a couple of the loyal listeners joining us today, so feel free to throw your questions in the chat. But without further ado, we might get stuck into it now. And I think, Fadi, you're going to hit us up with numero uno, and then we might just go a bit back and forth and see what we learn out of today's session.
Yeah, absolutely. Like Jared said, this is a lot of things that we see here as part of Positive. Really, it's about, where these myths come from. It's a lot of backyard barbecue talk and listening to a lot of people that have opinions rather than expert opinions. So we've piled together 10 myths that we really come across here all the time at Positive, top 10, if you will. And we'll kick us off with the first one. So the first myth that I encounter here is that there is only one Australian property market, and how this comes across is, well, what's happening with the Australian property market, right? The reality is the idea that there's a single national property market, that is very misleading, because Australia is made up of multiple property markets. Each have their own cycle, trends, influence, and factors. Even within a single city, different suburbs and property types can behave very differently. And really savvy investors analyze market trends and at a granular level, rather than just relying on a general media report that oversimplify the property landscape. So there's a few things or 5 different categories that I'm going to break this in, right? The 5 main categories are going to be state and territory markets, are going to be capital city versus regional city, suburb level markets, and then property type markets. And last but not least is the price bracket market. Each of these markets operate independently based on local economy, population. So when investing, it's important to analyze the market on all those 5 different levels within Australia and apply a strategy that aligns with yourself. And that's myth number 1. I'll hand it over to you now, Jared, for myth number 2.
Thanks, mate. Myth 1 busted. I'm going to talk about properties increasing in value every year. People just think this is the case, but property values generally rise over time, right? But they don't increase every single year. Markets move in cycles. They're influenced by things like interest rates, supply, demand, economic conditions, all of that sort of stuff that goes with it. And some areas experience flat growth or even price drops during corrections as well. So when understanding the property cycle, the market moves through different phases, such as boom phase, where prices surge and demand is really, really high. Peak phases where, growth starts to slow as affordability starts to drop away. Downturns, prices decline due to oversupply or economic shifts in the background, but also you have then recovery after that as well, where demand starts to return and growth resumes. So not all properties grow at the same rate. High demand locations, limited supply, and strong infrastructure drivers normally result in better long-term performance. So the key to long-term growth really is around buying the right property. That investment grade property in high demand areas tend to outperform. Diversity, putting all your eggs in one basket is never a really good idea. So avoid putting all your money in that one location and really holding for the long term as well. Riding out market cycles prevents forced sales in downturns. So the bottom line with this one really is around the Australian property market is a proven wealth building asset, but it's not a straight line up and down. Smart investors understand cycles. They buy well, they never sell. There it is. And they plan ahead to stay in the game. So that's myth 2 from me, Fadi. Over to you for myth 3, mate.
Absolutely. I agree with that, Jared. It's never a straight line. We just have to be able to hold the downturns and continue up and hold for the long term. So good one there. The third one that we have is property investment is fun. And I hate to pop the bubble for everyone that's out there, but what I mean by property investment is fun, and that is a myth, is the idea may seem exciting, but really successful investing should be based on logic, research, patience, rather than emotional impulse. Right? The reality is the best investment strategies are really often methodical and sometimes even a little bit boring. For smart investors, you really want to focus on numbers, long-term trends, and financial discipline rather than emotional highs and short-term market hype. For us, really, it's a well-structured portfolio to generate wealth consistently over time, freeing us to enjoy life rather than stressing over those decisions. And so there's a couple of key things that I want to go through here, why property investing should be just a little bit boring. It's about long-term wealth, not short-term thrills. Emotion should be removed from the decision-making. And finally, it requires patience and resilience. That being said, the end result can be very, very, very exciting. Financial freedom, passive income, the ability to live life on your own terms. But the process itself, if done right, it should feel predictable, structured, and even a little bit boring. So property investing, third myth, should be strategic, structured, not so much exciting and fun. The result should be, but the process should be very intentional and strategic. That's myth number 3. Over back to you, Jared.
Awesome, Fadi, mate. Awesome. Myth 4, all properties make great investments, but just because a property can be rented out, it doesn't mean it's a really smart investment. Around Australia, we have around 11 million dwellings worth over $10 trillion, but only a small percentage truly outperform the market. Some properties, like mass-produced high-rise apartments, sometimes in central CBD locations, often struggle with oversupply, low demand, and poor long-term growth at times, while there might be very strong rental yields initially, their capital growth potentially can be questioned over time. But what does make property investment grade? Well, the best investment properties have that high demand, low supply factor, located in areas where population growth are limited and also, or is increasing, and housing supply is limited. Owner-occupier appeal, properties that attract buyers, not just investors, tend to grow more in value this way as well. And you want to have proximity to lifestyle amenities, close to schools, transport, cafes, parks, jobs, etc. Scarcity factor, unique properties, tightly held locations in those NIMBY areas where possible, not in my backyards, not mass-produced a product either. And you want things that are going to have strong rental demand as well. So low vacancy rates, solid rental returns. And really for this myth here, the bottom line is that not all properties are created equal. The right property is about the right location can supercharge your wealth, while the wrong property in the wrong location can potentially hold you back for years and years. Smart investors focus on quality, not just the yield. That's myth 4. Busted, Fady. Over to you, mate.
Well said there, Jared. Myth number 5 for today. The myth is invest in your comfort zone. While it's not really expressed as invest in your comfort zone, generally speaking, well, many Aussies make the mistakes of buying properties in areas that they're personally familiar with, right? Such as this is their hometown, favorite holiday spot. But because you know an area well doesn't mean it has strong investment fundamentals. Really, when you look at investing, it should be a research-based growth. It should be based on research, growth potential, demand, rather than personal attachment. Sometimes the best opportunities lie in locations outside your immediate, more comfort zone or your own backyard. And this is really where this can be interstate or in locations that you're not necessarily familiar with. So the reason why investing in your comfort zone can be a little bit risky is because there's limited market knowledge. Sometimes we can be swayed by our emotions if we're attached to a particular property. And last but not least is really the opportunity cost. What opportunities are you missing out on because you're investing in your own backyard or something that you're familiar with? Well, what is the right approach then? Well, the right approach is invest where the numbers make sense, first and foremost. Use expert data, not just being familiar with a location. And last but not least is think nationally, not locally. We say this all the time. Think of yourself as a borderless investor. The key is really to invest where money works hardest for you, not just where you feel the most comfortable. Myth number 5 is invest in your comfort zone. The reality is we have to be investing outside of our comfort zone, but ultimately where the numbers make sense. We've got a question there from Tim. We will go through with the next slide. I'll hand it back over to Jared, and then I'll address your question in a second, Tim.
Yeah, and good morning for anyone that's just joined us a little later. A couple of people saying g'day in the chat. G'day, Luke Doran. How are you, pal? And Tim Lowry there as well. G'day, Tim. Hope you're traveling better, mate. And Bobby Probin's there saying g'day to us as well. So welcome, gang. Well, I've got myth number 6, and it talks around always following the crowd, that FOMO. So following the herd can be a costly mistake in property investment. Just because an area is booming, it doesn't mean it's the right place to invest for you. Many people rush into the so-called hotspots at their peak, overpaying just before prices stagnate or even correct themselves. So the danger of FOMO, fear of missing out, and that media hype is that while around FOMO, it leads to impulsive decisions without proper research and due diligence. Media hype often report on past successes, not the areas that are set to grow next or into the future. Smart investors think about this differently. Instead of following the crowd, savvy investors focus on those long-term fundamentals, investing in areas with population growth, infrastructure projects, and that economic or employment. So that's the PIE principle that we talk a lot about here at Positive Real Estate: population, infrastructure, employment. We'll look at things like data-driven research, studying historical data trends, supply versus demand, future developments, and all of this is covered in our wonderful 30 to 40 page property information reports that we produce for all of our clients, all of our private mentoring clients, that is. And strategy over hype, a well-planned approach always outperforms emotional, fear-driven decisions. The best opportunities are found before the crowd catches on. Invest based on data and not and fundamentals, not your emotions and what you've seen on 60 Minutes or a current affair, that sort of noise. That's how you stay ahead of the market, not just following the wave. You want to be able to ride the wave eventually. So that's myth 6 for me, busted. Fady, over to you, my man.
Yep. Great and well said. And Tim, I definitely just read your comment. I definitely agree with you. You know, with the pie, not the pie formula, with the macro micro niche layers that Sam Saggers often talks about. He says, the macro indicators, micro indicators, but with the niching, it's just about being able to find the highest quality property on the street, right? And like you said, sometimes the two properties right next to each other will perform very differently. The higher quality one will have higher demand, therefore it will get better results. So definitely agree with you there. On to myth number 7, cash flow is king. This is one that we hear way too often. And why is it under a myth? Well, let me just explain a little bit and elaborate on this one. So cash flow is very, very, very important for sustaining a property portfolio, but capital growth is what ultimately generates long-term wealth. For us strategic investors, we have to prioritize capital growth in the early stages. This builds equity and enables further purchases. Once a strong asset base is established, then we can shift our focus towards cash flow for passive income. The saying cash flow is king is really often heard in property investing, but the reality is capital growth is what builds real wealth in Australia. So what is that right approach, right? Well, we always want to go with a balanced approach. And this is a way to approach your property investing journey. Everyone's going to be at different stages of their lives. Everyone's going to start differently. This is a way of getting started that is quite a balanced approach. No one has a straight arrow, perfect approach. It's always going to be tailored to your situation. But a balanced approach looks like capital growth first, build equity and wealth through high growth locations, then cash flow to hold the assets, ensure you can sustain your portfolio during market downturns, and last but not least, use growth to buy cash flow. Once your portfolio has grown, you can use the equity to invest in cash flow positive strategies. So cash flow keeps you in the game. This is the takeaway. Cash flow keeps you in the game, but capital growth is what gets you out of the rat race. Myth number 7, cash flow is king. Back over to you, Jared.
Busted. Nice one, mate. Nice one. I'm going to talk now about finance for a minute. What about this one? Always go for the lowest interest rate when you've got a few finance options on hand. The reality here is that a low interest rate might seem like a great deal or the best deal initially, but it's not the only factor that matters when financing an investment property. The right loan should take in other factors like supporting your long-term investment strategy, not just offer the cheapest rate. So here's a few myths around why the lowest interest rate isn't always best. Sometimes loan features, they do matter. Offset accounts, redraw facilities, flexible repayment options can save you more money and time over the long run. Lender policy and borrowing power. Some low rate lenders have stricter lending criteria, which might be able to limit the amount of money you can borrow and scale and leverage into the future. What about fixed versus variable rates? Fixed rates may be cheaper, but often come with restrictions, while variable rates offer that flexibility, which is what we're going to need when we're moving forward and expanding our portfolio. Long-term strategy needs to be kept in mind as well. A slightly higher rate with the right features can help you grow your portfolio faster, especially in the first phase being acquisitions phase, where you're getting those big rocks under your belt. What should you do instead? Well, work with a mortgage broker. The internal team here at Positive Real Estate, Positive Money, the gang are shooting it out the park at the moment. They'll help you find a loan that fits your investment goals. Positive Money, I've had great success with the Damien and the team recently, helping people borrow more money than what we thought they could. Look at the total costs of these fees as well. Consider fees, flexibility, long-term benefits, and not just the interest rates on offer. And ultimately, think ahead. Choose a lender that allows future property purchases and refinancing options. And this is why the lowest interest rate isn't always the best option, but a well-structured loan with the right features can help you set up long-term success in property investing. Always look beyond the interest rate. So that's the myth busted here. Number 8. Over to you, Fady.
Very well said, Jared. Well, over to mine. Ninth one, final one for me is debt is bad. We often hear this one, but the reality is not all debt is bad. What is bad is unmanageable consumer debt. That can be detrimental, right? But strategic use of debt, which we call leverage, is a key tool in wealth building. For us, smart investors, we really have to understand the difference between bad debt, which is used for depreciating assets, and good debt that is used for acquiring income producing assets. That is the difference between the two. Leveraging borrowed funds and effectively using that to grow our portfolio will really allow us to maximize the returns and also managing the risk appropriately. So debt itself isn't bad when investing. It's how you use it that matters. And for us investors, we have to understand that productive debt can be a powerful tool for wealth creation, and bad debt is a financial trap. Not all debt is created equally. The good kind can lead us to our goal of financial freedom. Myth number 9. Back over to you, Jared, to close it off with the final one for today.
Thanks, mate. And I love that. Not all debt is created equally. Absolutely fantastic. And I've got the pleasure of rounding us out for this morning. Myth 10. I'm too old. It's too late to invest. And the reality is age should not be a barrier to property investing. While starting earlier helps with long-term growth, especially that compounding capital growth, even older investors can benefit from smarter strategies. Options like self-managed super fund can turn retirement savings into property assets, providing strong cash flow and financial security. Investing just isn't about personal wealth. It's all about creating a legacy for future generations. And I know a lot of my clients inside the mentoring program are doing this for this reason, amongst others, is really laying a legacy foundation for future generations. So age isn't a barrier. Different strategies for different ages. Younger investors focus more on long-term growth, while older investors may prioritize cash flow and income. Smart shorter loan terms are available often. Lenders often offer options like interest-only periods, principal reductions, or shorter loan terms to suit older borrowers. You can leverage some of that existing equity as well. If you own property, you may be able to use equity rather than taking on larger new loans, put in bigger deposits perhaps. And here are some smart moves for older investors as well. Focus on those higher growth income generating properties to boost that cash flow and build wealth quickly. But also considering those joint ventures or partnering up with other people as well to share costs and risks. So joint ventures here at Positive Real Estate have been great for a lot of the older clients as well. Work with financial experts to structure investments for tax efficiency and long-term security when you're near exit stage, or you might be a bit further down the line. But the key takeaway here is that it is never too late to start building wealth through property. The key is choosing a strategy that suits your timeline, risk tolerance, and also your financial goals, and keeping them in mind at the same time. So g'day, Nicole. Nicole's saying hello in the chat. That's it for the top 10 myths. There's some of the myths that Fady and I are often working through and talking to clients about, making sure they're all, in the same, on the same page and knowing fact from fiction, really. Tim's just asking a question in the chat. At what stage should you consider more cash flow property? Is it number of houses or asset value or combination of both? Tim, it absolutely just depends exactly where you're at, mate. Like, what are your goals? And currently with your numbers and where you're at in your wealth creation plan, are you on track or not? Like, do we got to put the foot to the floor a bit more, buy more assets, or is it time to start turning our passive income, into more cash flow as you get older? So it just absolutely depends. And I'll get you to book in with me, Tim. Get in there and grab a strategy session with me, and let's break it down a little bit. Fady, how do you think all that went?
Yeah, 100%. Definitely agree with you. There, it's about where you are and meeting your long-term goals, and then reverse engineering the plan from there and understanding exactly what you need to do in order to be able to hit those goals. But and Nikki, good to see you here today on Wealth Coffee Chats. I hope you've been able to catch it from the start. If not, this is recorded and will go live. We have gone a little bit over time, so thank you everyone for tagging along and staying a little bit longer with us. For the Melburnians or daylight savings time, it's going to be over. Queenslanders, everyone else, hope you guys have a great start to the morning. And that has been the top 10 myths from myself and Jared this morning. We hope to see you again soon here from the advisory team. And if you have any questions, we've got our email addresses running at the very bottom. Feel free to reach out to either of us, and we'll be more than happy to reach out to you and have a conversation. Any questions, reach out to your coach or your strategist, and they'll be most certainly be able to help you with any of the things that we've discussed today, if it has given you a few ideas. But for now, have a great week, and we look forward to seeing you next time. Bye-bye.
Thanks, team. Good morning. Have a great day. Bye now.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on notifications so you never miss a thing when we go live. Portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6 Star team here at positivementor.com.au.